The CAPM model, calculating the required return. John has spent the last few lessons building a mental map of the financial world. He understands that the past offers lessons about returns, that diversification can wash away specific risks, and that beta measures how much he is still exposed to the unavoidable storms of the market. But now, John faces his most practical challenge yet. He has a new opportunity to expand his business by launching a high-tech smart keyboard line. This project requires a massive upfront investment. John's big question isn't just, will this make money, but rather, will this make enough money to justify the risk? To answer this, he needs a bridge between risk and return. This is where the capital asset pricing model, or CPM, comes into play. As Brealey, Myers, and Marcus explain, CAPM is the gold standard for determining the expected return on an investment. It tells John exactly what hurdle his project needs to clear to be considered a success. If his new keyboard line can't beat the return predicted by CAPM, John should simply walk away and invest his money elsewhere. The beauty of CAPM is that it distills the entire complex world of risk into a single, elegant formula. It argues that the expected return of any asset is determined by three specific components: the risk-free rate, the asset's beta, and the market risk premium. John starts with the foundation, the risk-free rate. This is the starting line for all investments. In the modern world, this is usually the yield on government treasury bills. John realizes that if he puts his money in T-bills, he is virtually guaranteed to get it back with a small amount of interest. He takes no risk, so he gets a baseline return. If the risk-free rate is 3%, John knows that any business venture he starts must earn at least more than 3%. If it earns less, he's literally working for nothing, as he could have made 3% while sleeping. Next, John looks at the market risk premium. This is the extra prize the market offers for stepping off the sidelines and into the risky world of stocks. Historical data from earlier lessons show John that, on average, the stock market returns much more than T-bills, usually about 7% to 8% more. This difference is the premium. If John decides to be a market player, he expects to be compensated for the headache of volatility. But John's smart keyboard project isn't the market. It's a specific venture with its own personality. This is where beta enters the equation. From his previous studies, John knows that beta measures how much his project will swing compared to the market. If the smart keyboard line is high-tech and experimental, it might have a beta of 1.5, meaning it's 50% more volatile than the average stock. Now, John puts it all together using the CAPM formula. Expected return equals the risk-free rate plus beta times the market risk premium. John pulls out his calculator. If the risk-free rate is 3% and the market risk premium is 7%, John doesn't just add them together. He scales the premium by his project's beta. For his 1.5 beta project, the math looks like this: 3% plus 1.5 times 7%. The result is 13.5%. This number is a revelation for John. It is his required return. It tells him that because he is taking on a project that is 1.5 times as sensitive as the market, he shouldn't settle for average returns. He needs to earn at least 13.5% to compensate himself for the systematic risk he is bearing. John realizes that CAPM is like a truth serum for his business plans. If his projections for the smart keyboard only show a 10% return, the project is a value destroyer, even though it's technically making a profit. Why? Because for that level of risk, he could have found other investments in the market that pay 13.5%. By choosing the 10% project, he is leaving 3.5% on the table. This is the true meaning of the opportunity cost of capital. As he looks at the security market line, a graph that plots the CAPM formula, John sees where every investment fits. Projects that sit above the line are bargains because they offer more return than their risk justifies. Projects below the line are traps. John's job as a financial manager is to hunt for those projects that sit above the line, providing his business with alpha or excess return. This model changes how John talks to investors. He no longer says, "I think this is a good idea." Instead, he says, Based on a systematic risk of this industry and the current risk-free rate, this project offers a return that exceeds our required hurdle rate. He is moving from a world of gut feelings to the world of scientific finance. He understands that he is not just a maker of keyboards. He is a manager of capital. John concludes his analysis with a sense of clarity. CAPM has taught him that you don't get rewarded for just taking risk. You only get rewarded for taking market risk that cannot be diversified away. He now has a precise tool to measure exactly how much that risk is worth in dollars and cents. He closes his textbooks, ready to apply this formula to every decision he makes. Whether he's buying a new 3D printer, hiring a software team, or investing his personal savings, the CAPM formula is now his compass. He is no longer a dreamer. He is a disciplined architect of value, ensuring that every move he makes is backed by the rigorous logic of the modern financial stage.